So the final part of this module is about the statement of retained earnings and just adding two things in particular to our working knowledge of the statement of retained earnings. That is that sometimes we have to make adjustments, both of them net of tax, for changes in accounting principle, and then for also correcting errors that happened in prior periods. So these are adjustments that need to be made to retained earnings because if they have an income effect, right? If there's an income effect that is brought on by us changing accounting principles or by us finding an error in a prior period, then that income bled into retained earnings when we closed it out in that prior period. And so we're not going to make the adjustment to income during this period, even though these had income effects. We're going to bring that in by altering the retained earnings of the beginning retained earnings of our current period. So both of these represent prior year income effects. And we bring them in through retained earnings. It would be in violation of the revenue recognition principle, in the expense recognition or matching principle, to include changes that are expenses or revenues or gains or losses due to these guys in current period income, because those expenses revenues happened, they pertain to activities and transactions from prior periods, not the current period. And the income statement should only have revenues and expenses that arose because of current period transactions. Of course, then we also have dividends and net income that affect the statement of retained earnings. Hopefully that's known to you by now. And then finally, this isn't a big deal, but there can be restrictions on retained earnings. And typically that does have to be disclosed. It'll be called apportioned retained earnings or restricted retained earnings. And all that indicates is that it cannot be used for dividend payments. And this is sometimes just a legal rider that is put into a company that is put on a company when they borrow money. Because basically the person they're borrowing money from is like, hey, I don't want you paying your shareholders your profits. Those need to come to me in interest, right? So anyway, this is an enhanced version of the statement of retained earnings, where we start with that beginning retained earnings. We make adjustments for these two items that had income effects in a prior period. We net tax from those because if they had income effects in a prior period, then it was also taxed in that prior period. So we need to net tax from those two items. That gives us an adjusted beginning balance. Then we can kind of proceed as we know, add net income, or if it's a loss, subtract it from our retained earnings, our adjusted balance, and then subtract any dividends declared to our shareholders. That gives us our ending retained earnings. So the big picture idea, as I said, if the irregularity affects prior period net income, we have to correct that irregularity by altering retained earnings of the current year. And that is because we close all net income to retained earnings. So if this is in a prior period, those irregularities have already been closed into retained earnings and are getting carried forward in retained earnings to the current year. So that's why we then go to retained earnings, because that's where the problem is. That's the source of the error. And then again, because all items impacting income also have a tax impact, the adjustment to retained earnings must also be net of tax. So one of the things that is affecting prior period net income is when we change accounting principles, and that is changing from one GAAP to another GAAP. A very common example, the one I usually use, is changing from LIFO to FIFO or FIFO to LIFO. Whichever way, you're changing from one GAAP approved method to another GAAP approved method. And this isn't something companies can do all the time, nor would they want to do all the time, because if we have a company that has been reporting, say, in FIFO for all the years since its incorporation, and it wants to change to LIFO this year. Then, because of the consistency of information, which is a hallmark of accounting information, that we want it to be consistent from period to period for the same company, right? We can't have a cost of goods sold and an inventory number last year that was in FIFO, and then have a cost of goods sold and an inventory that is in this year LIFO terms, because they will be different. And we won't know if the difference is because there was a change in the operations, if there was a change in the cost that the company was getting when they were buying inventory, or if it was just simply a change from one cost flow assumption to another cost flow assumption. And as I mentioned, hey, this is not just going to affect, in the case of LIFO and FIFO, it's not just going to affect cost of goods sold, but it's going to affect the inventory balance as well. So we have to think of all of those things in tandem. It's not an easy change for a company to make. So let's consider, we have a company, 20x5, it's used FIFO inventory cost flow assumption for reporting cost of goods sold since it was incorporated. In 20x9, the company decides to report with LIFO. So therefore, it's going to have to go and not just adjust this year, like, oh, okay, we'll switch our FIFO cost flow numbers to LIFO for 20x9. Nah, we got to go back to 20x5, 20x6, 20x7, all the years since it was incorporated. For some companies, this could be 30, 40, 50 years. The amount of processing and even maybe the availability of the data to do it is going to be very taxing on the company, on the company's accountants anyway. So what we're looking at then is, what was the effect, right? The income effect. We're just looking at the income effect here because we're talking about the income statement, right? Retained earnings. So the income effect of 20x5, right? We reported, and these are all pre-tax cost of goods sold that were reported. So it was using FIFO. It reported $50 cost of goods sold under FIFO. But if they had used LIFO, it would have been 90. So this switch for 20x5 has a negative $40 effect pre-tax on my income. Right? Then we look at 20x6. It reported cost of goods sold as 65 under FIFO, but if it had used LIFO, it would have been 100. So that's a negative $35 effect. If we're talking about switching now, remember, we got to now report, we got to change everything to the new reporting style that we're adopting. Here we have 85 cost of goods sold and 20x7 under FIFO versus 110 under LIFO. So the difference between those would be 25. And then finally for 20x8, it's another difference of 40. So we take all of these together. These are all my prior period adjustments that I have to make, right? Or the effect that these prior period adjustments had on my total income. 40, 25, 35, 40. So we got 80. And then this is all together, yep, 60. And so that would be $140 if we consider the combined effect of this change. Remember, this is pre-tax. So my current retained earnings of 3,200 for 20x9 was based on this top row of income reported numbers, right? But those numbers have changed. And the total effect of that change is a reduction of 140 income. So that's pre-tax. If I'm going to take that tax out, and again, let's just assume a 20% tax rate, which is where they are about these days for businesses. We're going to take the net of tax rate, 0.8, and that will be 28, 112, I believe, if I did the math right in my head. Yep, 112, verified on calculator. So this would be the net of tax effect of those earnings changes. Now, think about what the retained earnings statement would look like. We start off with $3,200. This is my unadjusted beginning retained earnings. Then we have a cumulative effect from a change in accounting principle. I'll just call it a change in accounting principle. And that is net of tax. And after I combine that with my beginning retained earnings, I get the adjusted amount of retained earnings based on the fact that now I'm reporting all of my prior years in LIFO instead of FIFO. Right. Then, of course, we would just add net income, subtract dividends, the usual, and we would get our ending retained earnings. If I had given this to you, you couldn't do the full one, but really what I want to call attention to with this is just where we insert this, what the effect is, what I'm talking about when I'm saying, hey, it'll have an effect on income that we need to now incorporate in order to get a consistent view, consistent information for this company year over year. Now, this happens when a company changes accounting principles. This is not what happens when there's a new principle that's adopted because a company is now dabbling in transactions that require it to apply an accounting principle that because the transactions are new, the company never had to before. So that's not right. We just followed the gap that we need to follow. It's also not a change in accounting principle if the company was doing the wrong thing or misapplying an account or misapplying an accounting principle. So this is only true when we switch from one GAAP sanctioned method to another GAAP sanctioned method. And if it's not that case, if it's like a misapplication, then it's an error, right? If we were doing the wrong thing, that's not GAAP, and then we move to GAAP, then that's what we call an error or the correction of an error. It's a different adjustment, right? So when we have a correction of an error, right, it could be, as I said, misapplication of accounting principles. It could be a mathematical mistake, or it could be a bad faith estimate. Like we purposely skewed an accounting estimate because we're trying to commit fraud or earnings management. Those are all corrections of errors issues. So we call them prior period adjustments. And because again, remember this happened in a prior period. So if the error arose in a prior year, right? So perhaps we're in 20x9, this is 20x7 or 20x8, doesn't matter, prior year. In the year the error is detected, so the current year, we report the impact to net income as an adjustment to the beginning balance of retained earnings net of tax. So we do basically the same thing here. We just make an adjustment like we did with the change of accounting principle. It has to be net of tax. But the thing we don't do is we do not adjust current income because current period income should only be the revenues and expenses that arose from economic activities during this period, the transactions we engaged in during this period, right? The error happened in a prior period. We don't correct it by changing or adding or adjusting depreciation expense or whatever we're adjusting in this period. And if the error arose in the current period prior to closing entries, then yeah, we're fine. We can adjust the revenue or the expense on the income statement this period. So it's all about when the error took place. If we caught it before it entered retained earnings, then we're fine. If we catch it after, it's been closed, then we're in the next period already. We have to adjust through beginning retained earnings. So in the current period, 20x9, the accountant determined that pre-tax depreciation expense was overstated by $120 in 20x8. So we have current period discovery of a prior period error. In that case, we have an overstated depreciation expense and it's pre-tax, so we have to be wary of that. So if we overstated depreciation expense by $120, then what happened to net income? So just be careful with that, because if we overstate depreciation expense, then that means that our income was understated. So that means to adjust correctly, we have to adjust by increasing retained earnings. So too much of an expense leads to too little net income. That means that we want to increase current period retained earnings. So if we overstated depreciation expense by $120, and that's pre-tax, then that means we understated net income by the net of tax amount. So again, we want to take that 120, take the after-tax tax rate of 80%, because that's what would be left over after we strip the tax effect. And that becomes $96. So on a net of tax basis, this error would be a $96 understatement of net income, which means that we would want to increase retained earnings by $96. And that's it. Right. The journal entry to record this, just in case you're interested, there is one. For this particular case, it's kind of a closed system. If we want to increase retained earnings by 96, well, retained earnings is a credit-based account, and we would record the 96 there. Now, what do we debit? We don't want to debit depreciation expense. That would be overstating this period's depreciation expense, right? But if we overstated depreciation expense, think of what was also overstated, because whenever we record depreciation expense, we debit depreciation expense, we credit accumulated depreciation. So if we overstated how much we debited depreciation expense, the credit to accumulated depreciation would have been 120 too high. So we want to debit our accumulated depreciation by 120. And now you're like, wait a minute, why is this off? Right? It should bother you if you understand debits have to equal credits. The filler is the amount of tax that was not recorded that should have been recorded in that period. And that is equal to the tax effect between the two, which is 20% of 120. All right. The final item, change in accounting estimate. This just happens a lot. So companies have certain values they estimate for many things in accounting: salvage value of fixed assets, useful life. They might change depreciation methods. All of that affects depreciation expense. If we change how much of our accounts we think are going to be bad debt, that changes my bad debt estimation. So there's lots of accounting items that we try to estimate to the best of our ability, right? This has to be a change from a good faith estimate, or something that's reasonable, to a new estimate that's also a good faith estimate. So what good faith means is that we're not trying to manage earnings, we're not trying to commit fraud, right? We're not trying to hide anything, poor performance or whatever, because if that bias were present, then our change would become the correction of an error, not just a normal change in accounting estimate. This one's the easiest to deal with. There's no need to alter prior estimates that happened in the past, because it's because the estimates in the past were good faith, that means that they were estimates in the past for a reason, right? Because of the information, the economy, whatever was going on at that time led us to believe this was a good faith estimate. But now things have changed. Now we have a reason to change it. So there's no error, there's no restatement. The information is still consistent because we're always going to have to change things just a little bit. So do not retrospectively restate any financial instruments, no cumulative adjustment. We just simply alter our current and future estimates going forward. So we changed depreciation expense because we decided our assets don't have the estimated useful life we thought they had at first. So we recalculate that number this year and move forward with that new estimate.